Curious about stocks but not sure if they're right for you? In this video, I will outline why you should be investing in the stock market. Come check it out. Hi, I'm Lachlan Campbell, the founder of Mad Success, empowering you to financial freedom. What that means for you is a life without money worries. Is that hard to imagine? Then let's change that. With Mad Success, you'll learn the languages of money, understand why you stress about money, how to reduce that stress, improve your financial health, and ultimately live a happier, wealthier, more fulfilled life. Step 12 in the 12 Steps to Financial Freedom program is all about investing. And this is one of our Step 12 videos. So, if you've never invested in the stock market, listen up. This video is a practical guide explaining why you should be investing in stocks. I will use data and statistics for the United States because there's an abundance of information available and because they have two of the largest stock markets in the world, the New York Stock Exchange and the NASDAQ Stock Exchange. As an investor, new to stocks, let's start with a few facts to consider. The wealthiest 10% of Americans own 89% of all US stocks. That's an incredible statistic to think about. The top 10% of wealthy people in America own 89% of all US stocks. So what are the other 90% of Americans investing in? Well, let's take a look at a few other data points. 70% of Americans have less than $1,000 in savings, including their investments. 45% of Americans have no savings at all, yet nearly 2/3 of Americans, 65.5%, own their own home. This is survey data from 2019, and the links are in the description below. It's generally understood, however, that American savings rates have actually risen during the first 2 years of the pandemic, despite job losses and business closures, because of stay-at-home orders, meaning less spending during much of the pandemic in general, and because of government financial support to households and their businesses. Bottom line, these statistics highlighted that A, your average American is struggling financially and they do not own stocks, but around 2/3 own their own home, and B, the wealthy own stocks as one of their primary sources of wealth. Now, let's take a look at a fascinating chart from visualcapitalist.com. Again, the link is in the description below. It shows the different types of assets and investments held depending on individual net worth. Net worth is the sum of a person's total assets minus their total liabilities or debts. The net result, positive or negative, is called your net worth. A goal over the course of your life should be to maximize your net worth over time as best you can, so having lots of assets and investments and much less debt. In case this terminology is new to you, an asset is anything that you own of significance that has value, like your home, your investments, pension money, or cash in the bank. You can read the different kinds of assets above and below on the chart as presented by each of the small circles, and they're all labeled. Liabilities are all of your debts, money that you've borrowed, such as credit card debt, mortgages, student loans, buy now, pay later scheme debt, and money borrowed that you have to pay back to your friends and family, and so on. The amount left over after you subtract your total liabilities from the total value of your assets is your net worth. If it is a positive number, then you have more assets than liabilities. If it is a negative number, then you have more debt, more liabilities than assets, which is very common when you start working with the weight of student loan debt and no or very few assets. That's not to worry. If you follow Mad Success guidance, you'll be on your way to a healthy financial future. Now, the top row of this chart shows households with $10,000 or less in net worth. Notice, the two primary assets shown for this lowest wealth bracket are represented by the red and orange bars. The primary residence, meaning the person's home that they own, not rent, and vehicles, the car or cars a person owns, both net of any debts owed for the purchase, such as mortgage or car loan. Pensions and cash provide the balance of their primary net worth, with stocks and businesses being almost non-existent, consistent with the data just provided, that the wealthiest 10% of Americans own 89% of all the stocks in the US. Notice how quickly cars become irrelevant to the wealthy, and the family home also significantly declines in significance with increased wealth. What matters to the wealthy is creating businesses and investing in stocks and funds, which would include hedge funds, mutual funds, and other alternative forms of investment funds. The wealthy are entrepreneurs, but the wealthiest have businesses that are publicly listed on the world's stock markets, and these people continue to own a large chunk of their company's stocks. Think of people like Bill Gates of Microsoft, Mark Zuckerberg of Meta, formerly Facebook, and Jeff Bezos of Amazon. These three people continue to own large percentages of the companies they founded and built, but that stock ownership is reflected in their business value ownership, the dark blue bars, rather than in specific stock portfolio ownership, which is the light blue bar. This is important data and highlights a key fact of wealth accumulation, that an investment in stocks should be an integral part of your asset base as you progress towards a positive net worth, financial stability, and ultimately to becoming financially free. So, here are 9 reasons why you should invest in stocks. 1. Stocks provide stable, long-term investment returns, which significantly outperform pure savings, especially given how low interest rates are currently. For example, the S&P 500 index, which can be viewed as the benchmark of the performance of the entire US stock market, has provided an average return on investment of 10.5% since its inception in 1957 through to 2021. An average 10.5% return every year over 64 years is an excellent return on investment. 2. Stock investing allows you to become a partial owner in a company or companies that provide products that you love or believe in. Companies like Apple, Tesla, Pfizer, Samsung, Nike, Adidas, Oatly, Beyond Meat, and so on. 3. Stocks have historically outperformed inflation. It is all the more important to stay invested during a period of high inflation, like we have now, as stocks have the potential to provide investment returns that beat inflation. This is important so that you maintain your overall wealth and not diminish your purchasing power, which can be eroded by inflation. Now, there's no guarantee you'll beat inflation, which this year is around 7.5% and rising. But at least there's a chance with stock investments to beat inflation. So, not including your emergency fund money and other savings that you need in the short term. But if you have other money just sitting in a savings account that you don't need for the next 12 months or an emergency, then that money should be invested in order to have a chance to outperform inflation. 4. Stock returns over the long run will help you to meet your retirement and total wealth goals. 5. Stock returns can also help you to achieve medium-term financial goals, such as building savings for the down payment of a home, though a decline in the stock market could delay this goal. So, how much of your savings you invest in stocks depends on the timing need of the money invested. If you need the savings in the next 12 months, do not invest that money in stocks. They can be too volatile over the short term. But if you don't need the money for, say, 2 to 5 years or longer, then that money can and likely should be invested in stocks. 6. Many countries provide stock investment tax shelters, such as IRAs in the US, RRSPs in Canada, and ISAs or ISAs in the UK, which enable one to invest in stocks within these structures without having to pay tax on capital gains and or dividend income. So check locally in your country what is available and what the rules are. 7. Stock investing puts your money to work for you to earn more money to grow your wealth. Your money can grow over the long term invested in stocks. We humans have an incredible capacity for progress and achievement. We invest in the shares of companies because over the medium and long term, good companies produce more, sell more, profit more, and their stocks go higher in value, providing you with long-term capital gains and possibly dividend income, thereby increasing your overall wealth over time. 8. As well, many stocks pay dividends, which is a form of passive income that you can use to either pay for your lifestyle or reinvest to buy more stocks, compounding your investment returns. 9. Lastly, investing in stocks can be fun if you take the time to understand what you're doing and only take on the amount of risk that you feel comfortable with. You should be able to sleep at night and enjoy the experience. You can start investing in the stock market with as little as $1. Yes, literally $1. I'll outline how to start investing in stocks in my next video, where we'll look at the minimum requirements you need to start investing safely and confidently. So, if you got value from this video, you know what to do. Hit the like button, subscribe to the channel, and please share it with friends and family and colleagues you feel might benefit from Mad Success in their lives. Thanks for watching. I'm Lachlan Campbell, and this is Mad Success. Cheers.